Hi, this is Keith Schneider, CEO of MarketGauge.com. This is our April 22nd edition, 2012 of Market Outlook. So just want to remind everybody you can get this service for free if you sign up and get it sent to you. Go to MarketGauge.com, www.marketgauge.com. Sign up for our free weekly Market Outlook newsletter. You'll get this delivered to your inbox every week. In addition, you can get just the video portion on YouTube if you choose to do that. We have our own YouTube channel. So, markets were quite interesting. What happened? Well, first of all, you can see that this ellipse right here is illuminating where we finished up last week. So when we talk about it's deja vu all over again, you can see we did the same thing this week. Now, we ended up with yet another inside day, just under the 50-day moving average. Now, a couple things have changed. We got a number of economic indicators that were negative. So even though we had some pretty good news early in the week and a monster move up, we sort of went sideways since then and basically closing right about where we started the move from earlier in the week. Now, a couple things to note. Number one, you can see we've got this trend line here. This is a very good trend line. We've got a low here, another test. So that is a valid trend line, and a series of new highs from here to here, which makes that trend valid. So with this slightly rising trend line here, a break of that to the downside would confirm that this whole piece here, this wedge or flag formation of sorts, is breaking down. Conversely, a move above this compression up here around 139.50 or so could potentially set up a scenario where we will end up with a potential test of the highs or even new highs, because you've got enough compression in here that could certainly generate enough interest to take us at least to a test of these highs. So we have to watch very carefully. Now, on another thing to note is that one difference from this week to last week is the fact that our 10-day moving average is now under this 50-day moving average. So there you have it. Another thing to note is that the volume on the down days way has surpassed the volume on the up days, and we've actually, through this sideways action, managed to register 3 more distribution days over the last couple of weeks. Not a really good sign, so that indicates some further deterioration. Let's take a look at some of the longer-term charts here. On the weekly chart, you can see the channel that we had put in from several weeks ago. We kissed the top of this fanning channel over here. So return move to the top of that channel at recent highs, certainly since 2008, and backed off from that. So you can see we are holding that critical 65-week moving average. So on an intermediate term trend basis, which is measured by the weekly charts, we are still intact, but a breakdown on that daily chart might bring us under 136 or so, and that would basically be a test or showing weakness in the intermediate term trend. So we are definitely at a cautionary point here, an interesting inflection point. Okay, let's take a look at the Dow, because a slightly different story there. We had a very, very sharp decline from the highs, recovered, and this is sort of a mirror image of what happened last week, except last week the market basically closed under the 50-day moving average, and then powered out, and we had a really big move in the bigger stocks, and then of course that was reversed. IBM's earnings came in quite poor, and you got a nice reversal later in the week. So basically we ended up up a little bit from the prior week, but not much. And basically, again, an inside day and sitting right at that 50-day moving average. So again, you've got a nice little wedge forming here. If we could power out and get above that 131, 131.30 level in the Dow DIA, could definitely power a move up. Conversely, a breakdown through the lows of Thursday would also be a cautionary move in the market, and potentially confirming that the breakdown under this 50-day moving average is for real, and that we are starting a potential intermediate term correction. Now let's take a look at the market internals. For the market internals, interesting, because we've got sort of a mixed picture here, because what's happened is in the broad market, the biggest cap stocks, this is the S&P 500, and so this is measuring the broadest gauge. The McClellan oscillator continues to work on its buy signal that was generated after the sell-off, and we've been sort of inching our way a bit higher. We had also gotten into oversold territory looking to generate the buy signal. We got it off the up-down volume, but the breadth had been weak, and we finally got confirmation on the breadth. So you can see we got to pretty decently oversold levels on this sell-off down here, and we needed to move above this red line here, the minus 2,000 on the advanced decline. We did that Thursday and Friday, sort of confirming the buy signal that had occurred several days earlier. Generally, I like to see these signals confirm within a few days of one another, but nonetheless, you can see we're working off short-term buy signals and more of an intermediate term, 1 to 3 weeks, on the McClellan oscillator, which is our intermediate term breadth indicator. So I would say things are looking a little bit more positive on the market internals, but sentiment clearly has been holding above the 50-day moving average. So with the market up on Friday earlier in the day with a lot more strength to it, we started trading under the 50-day moving average, which would have been reversing what I would call an intermediate or at least a 1 to 3 week type of sell signal for the market, but still intact. So something to keep an eye on. We want to watch this 17 level and the lows of Friday. On the other hand, that trend is still giving us a yellow flag here, a warning as part of our overall market indicators. So we have a mixed picture. I would give it basically maybe a slight positive considering where the VIX is sitting and where the other market indicators are. Now let's take a look at interest rates. TLTs, the 20-year bond. Remember, we had been fairly positive that rates were going to be moving up, and with that spate of bad economic indicators that started with our long Easter week vacation, they continued. So what's happened is the market in interest rates have continued to stay above this important trend line here that I had pointed out, that we really didn't want to see it eat too much into this resistance level. At the same time, we wanted to see this trend line intact for those rates to continue a little bit higher, which would have been signs of strength. But again, it's been persistent, and in fact, what we got this week was a cross of the 10-day over the 50. So you're basically back into a bullish mode, or lower interest rates seem to be pretty much a strong trend here. So, all we can say is that it's not bode well overall for the economy, but nonetheless, you have to read what the markets are saying. On the weekly basis, you can see another important point here is that we had been trading for quite a number of weeks under this 65-week moving average. We had been basically under it for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 3 months. Now we've had 2 successive closes above that 65-week moving average, sort of confirms that reversal in the trend, and it's again back the intermediate term trend in bonds, the TLTs, is back to positive, right? Positive because we're above the 200-week, above the 65-week, and we have now closed over it for 2 consecutive weeks. Okay, let's take a look at gold. Completely different picture here. Very, very interesting. Let's take a look at the daily chart. You can see we have a very, very clean descending channel here, of which we're in the middle. But interesting development this week, we crossed under the 50-day. The 50-day crossed under the 200-day moving average, a death cross. And we have basically, since late February, been trading under that 200-day moving average. The slope of that 50 is down through that 200. So market on the daily charts looking quite a bit vulnerable. If you step back and look at the bigger picture, we're still trading within the middle of the channel. So to look at the way this can be viewed is potentially look to sell strength against that 200-day moving average, as well as selling weakness under the support here and the compression of the last week. In addition, this is another critical level here around that 157 level, the low of April. Is also a critical level to watch. With taking out these levels, the first important level here is the recent 5-day low in the gold over here. The April lows again, and it looks like we could easily get a test down to that 140 level. Now, stepping back at the longer term trend, you can see that we've also now trading under the 65-week moving average right over here. This blue line here is the 65-week. The longer view on the weekly charts still intact, but potentially looking vulnerable based on the dailies. Now, going to the monthly charts, you can see again we're just hanging on to that long-term trend line. So be really interesting to see what happens, how that daily chart plays out. Because if that daily chart fails, you're definitely going to be seeing some of the long-term players calling into question whether the long-term trend in gold is still intact. So long-term, we're just hugging that trend line, still intact. On the weekly charts, still holding that 200 weekly moving average and trading above it. And the daily charts are starting to break down. So there you have it. I would start looking, as I mentioned, to trade off of those dailies. You got those key reference points. Looking at it on the flip side, we also want to watch this this trend line here over the last 3 months as it's forming a nice trend line on the monthly chart. So, stepping back and keeping an open mind to all different scenarios that could play out. Certainly, this test of the long-term monthly charts could remain intact, and again, a move above that 200-day moving average on the dailies might spur another move up and another potential test of the 175 to 180 level. But for now, the market is looking under pressure. So if you asked me and put a gun to my head and said, what do I think? It looks like the market is starting to roll over. But we're going to stay flexible, as we always must, and let the charts and the market action dictate what we do and how we manage our risk. So thanks for listening in here. Again, if you like this, please go to www.marketgauge.com, sign up for this weekly newsletter, and also you can join us on our YouTube channel. Now, just a reminder is that for the next 2 weeks, following 2 weeks, I'm going to take a needed vacation, so this will not be available to you for the next few weeks, but look forward to getting back when I get back from a long-needed vacation. Thanks, and bye for now. This is Keith Schneider, CEO, MarketGauge.com.